Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Monday. Hopefully everybody's having a GGD, a great green day in the market. You know I always wish the best for my viewers and subscribers. So guys, we're going to go over the overall portfolio value. Of course, we're going to go over the value by the metrics. Then we're going to look at our buying power as well as our individual holdings, how they're performing, what I purchased, and what is exactly on the watch list. All right, first off, for today, we are up 600 and around $60, a 1.1% return. Value sitting at $59,850. Of course, that will fluctuate due to market being open, but I'm not worried about the overall value of the portfolio. For me, the goal of this portfolio is to grow the passive income month after month. So for today, we're up $651. Then that 1 month mark, as you guys can see, it is not always green. We are down $117 with a 0.22% loss. Not a big dip here in the portfolio, but it does show that patience is important and you can't always react on the red days. Then for that 1 month mark, we're up nearly $2,400 with a near 4.2% return for that past month. That 3 month mark, we are up around $6,300 and 11.7% return in the past 3 months. Then we are up nearly $10,000 year to date with a 20% return. That 1 year mark, we are up $10,907, a 22.3% return. And then all time since I believe, April of 2018, we are up $24,497.08 with a 69.32% return all time. Guys, we have a buying power of $30.14. That was $195, but I went ahead and I bought a share of Realty Income and a share of T. Rowe Price because both of those companies are great. I wanted a little bit more of them, and I wanted to bump up my cash flow. So, jumping right into Realty Income, sitting today at $62.71. We have 171 shares, $10,724 of market value. Average cost is $65.02. Around 18% of the portfolio is in Realty Income. Today we're at $53. Total, we're down nearly $400 with about a 3.5% loss with a dividend coming in of $44.71. And guys, that dividend income just went up. So next month we will be getting paid a little bit more because I bought another share. So guys, I love Realty Income. It is a dividend aristocrat, a great monthly dividend paying stock. I love their business model, and that's really why I'm so bullish on this company. I do know that there have been quite a few of the dividend investing community at large on YouTube. A lot of the personalities selling out of this company simply because the dividend growth isn't as aggressive as they would like, and I understand that completely. If you look at it overall, this compared to something like a Visa or a Mastercard, it's not great. Honestly, the dividend growth is not anything to write home about. But I do see this as a safe haven for my cash. I'm getting a really dependable, like 5% return. So this is essentially my bonds. But I get to own real estate and I get monthly payments from this. So that's really what it's about, is growing that monthly income. And that's what the goal of the portfolio is, right? Is to build that monthly income. The overall value of the portfolio growing will happen over time as I add more stocks, the dividends grow. Maybe I switch out a couple companies, maybe the business model changes or something like that. Overall, the companies will grow if I pick good companies, right? And my goal is to not match or beat the S&P. I don't really mind it beating me out because I'm going for that monthly dividend income growing. And right now, guys, I make about $160 a month passively from dividend income. And Realty Income is a really good option for anybody looking to grow their monthly income, but they're okay not getting the biggest amount of growth year over year. But I love their business model, guys. It's a triple net lease, so they don't have any exposure to like the insurance, the buildings, like the expenses behind all of that. They don't have any downside risk when it comes to owning the properties. They just collect the rent. So the tenants are responsible for pretty much everything when it comes to the whole management side of things. And so that's why I like Realty Income. The other ticker symbol that does a really good job in that space as well, a ticker symbol NNN. I just prefer Realty Income because of the monthly dividend income. And guys, this really does help kind of even out and constantly boost up my monthly dividend income because it pays every single month. So there are quite a few reasons why I want to hold this for the long term. But I did get some questions about people asking why I haven't sold it. I love the occupancy rating. It's never been below, I think it was like 97%, even through COVID. They did a really good job of keeping and getting their rent, keeping their tenants and getting their rent. They have fixed income, which means that they have automatic rent bump ups every single year in their triple net lease contracts. So not only do they have rent going up, they also don't have any liability when it comes to the real estate that they own. So I love the overall business model, and even though the dividend growth might not be stellar, it's still enough for me to bump up every single month, and it's just continuously rewarding. Like, I want to own real estate. I've always talked about buying like a duplex or something like that. I just didn't have the cash flow when I was in my early 20s to do that, because most people don't nowadays. But this is my real estate exposure. This is my tenant, essentially. This is going to be the exposure that I'm looking for to real estate. So while other creators, I totally understand that they sold it, why they sold it, they had good reasons for it. I'm just going to hold it, let it keep compounding, and letting it buy me eventually, a share of Coca-Cola, Apple, maybe even Costco someday. That's what this is there for. It's just that steady income. Next up, we've got Altria, which is actually up lately, which is surprising because normally it's a sin stock and it drops. But it's at nearly $54 a share here. 320 shares, $17,000 worth of market value. Average cost is $47.27. So I'm up quite a bit here, which is very, very rare for Altria. Nearly 30% of the portfolio is in Altria stock. Today we're up nearly $100 with a 0.5% return, but total we are up $2,100 with a 14% return. So guys, this is the biggest single dividend payer in the entire portfolio. I understand it's a declining business, but I also have done a deep analysis on the company, and I do believe that their pricing power is going to keep them afloat, keep the dividend growing. They just boosted the dividend from 98 cents to $1.02. The payout ratio is exactly where management wants it and will likely keep it. So I'm not worried about the declining business overall. I'm using this to buy companies like Apple, like Google, eventually Costco, Berkshire, Visa, anything that I think is a higher quality company with a bigger price tag. I'm using Altria to buy it. So think of Altria as I put my money in here, it grows to a point, and then I put it into something that's a little higher growth. Realty Income is like that as well, but Altria is what I'm going to use to buy those big ticket items, as in a Costco, a Berkshire, or an Apple or Visa. So Realty Income is going to be purchasing something like a Coca-Cola or eventually a T. Rowe Price. Altria is going to be used to buy those like triple digit stocks. And it's done a very good job of growing the dividend as well. I think when I first bought it, it paid something like 83 or 84 cents a share. And over 5 years, it's all the way up to $1.02. So it's grown like 25 cents, which is a pretty, it's like a 4 to 5% growth rate, which would beat out inflation. As well as I've bought other companies with that cash flow. So I think overall I'm coming out way ahead when it comes to Altria. So even though it's a declining business, I do think that the brand, Marlboro, the pricing power for overall cigarettes, even though I know the overall rate of smoking is going down, I think that over time they'll be able to continue the pricing, and they'll grow over time, especially when they're doing alternative investments in stuff other than tobacco. I do understand that is going to be their cash cow for quite some time, but I do think there's a little bit of growth that could be seen in that market. Next, we've got Coca-Cola at $72.18. We've got 15 shares. right around $1,100 of market value. Average cost is $60.54. 1.8% of the portfolio is in Coca-Cola. Today we're up $15. Total we're up nearly $175 with a 19% return. Guys, this is just like Altria. I don't know why it's up super big. I looked for like some news possibly, but I do see that there's a couple of banks that have bumped up their price targets, which is that's a good thing. I mean, they're bullish on the stock, but I don't think that justifies a 1.5% bump up or a premium of 7% or 20% on the stock. So I'm going to sit pretty on my Coca-Cola shares and just wait for the price to come down. Eventually, analysts won't be as bullish on the stock. People will put out more articles about how slow the dividend is going to grow or how Coca-Cola is not growing at the rate it used to, something like that. There's always going to be some bad news around the corner that's going to make this stock a buy for me. So this is kind of in the same vein as Altria. Not the best grower, and I totally understand that, but it's a company I use every single day and I want exposure to. So overall, guys, I think this is overpriced. I'm not selling my shares. Obviously, I love Coca-Cola, but I'm not buying at these prices. Next, we've got Apple at $220. We've got 6 shares, $1,300 worth of market value. Average cost is $210.88. 2% of the portfolio is in Apple. Today, we're down $4. Total, we're up $55 with a 4.3% return. Guys, Apple is one of those that I just bit the bullet and just started buying. Even though I do think it might be a bit overpriced here, since stock splits and whatnot, the price has gone down. I mean, people, it was at $500 a share. Now people see it at $220, and they're like, oh, well, since the stock split, it dropped $300. That is not how that works. Stock splits are relative. The value stays. It's just more shares outstanding. So I know a lot of people were worried about the stock price going down from 500 to 200 when that happened, but it just changes the way a little bit that you value the overall company. Now, I do know that there have been some rumors of a shakeup at Apple over like the board or some fundamental changes. I'm okay with that, guys. My big thing about Apple is not necessarily there. I know there's been a lot of talk about the iPhone sales. I don't care about the iPhone sales. I care about the money that people spend on their iPhones and how the utility of the iPhone is used every day within people's lives. That's what I'm buying it for. I'm using it for the utility of the product, not the sales of the product. So I am interested in Apple and Apple's iPhones and how many they sell, but I'm also excited to see iPhone sales drop a little bit because then the stock will crater. People will think Apple's losing their touch. Something or the bad news will come around and I'll be able to buy Apple below my average cost. That's really what I'm looking forward to. And for me, guys, I'm more bullish on the services segment versus Apple iPhone sales. So for me, as long as that revenue over time is going up for that segment, I don't mind Apple iPhone sales dropping a bit, as long as that revenue staying consistent and or growing for services. I mean, I've looked at services for a really long time, and it took me a while to really jump into Apple. I looked at it for a long time. And then eventually I'm like, you know what? I gotta do it, right? It's one of my favorite companies. I watched the Steve Jobs movie with Ashton Kutcher like a million times. I don't think you can beat the utility of the product and how absolutely and undeniably attached people are to their phones. It's just Apple. I see it as such a unbreakable ecosystem, as well as people are just so mentally attached to their devices now, and I don't think that's going to go away. It would take a lot for this overall competitive advantage to change, and it might in the future, and if it does, I might consider allocating less capital to this position, but I don't see that going away anytime soon. So I'm very, very bullish on Apple, specifically for the services segment and the utility of the iPhone. It's not about the sales for me. It's about how people use their product and just how undeniable the ecosystem is. So guys, overall, I do want Apple to be the single biggest position. So I have bitten the bullet a bit and just bought some, even though my average cost before was at like 160, 180, something like that. I just decided to start buying it in the 200s. I'm like, screw it. Overall, I love the company. I do understand that I'm buying it at a higher valuation, which means my overall returns will probably be a little bit lower than they were, but I'm okay with with buying consistently and then having cash on the side to my goal is to double up on the position when it's down like 50%. So we'll see how that works out. Overall, I might not have the best overall return with Apple, but I'm excited to own more of the company. Then we've got Abbvie at 196.10. We've got 95 shares, $18,000 worth of market value. Average cost is 95.20. 31% of the portfolio is in Abbvie. Today we're up $250. Total, we are up $9,500 with a 106% return. Guys, this is, and it has been for a long time, my best performing stock. I bought it during the Allergen acquisition. They were buying it. Abbvie went down. Allergen went up. People were worried about the shakeups that were going to happen when the companies merged. They were also super worried about the Humira patent expiring for Abbvie and saying that they would not come out or had drugs in the pipeline that would cover that expense, that revenue stream, and the expenses and different things coming together with the companies. There was a lot of issues foreseen with that merger, and a lot of them were blown up and blown out of proportion. And now I'm sitting and riding the wave that is the combined company of Abbvie. So overall, guys, I feel like I did a really good job analyzing the company, their cash flows, and being more realistic about the loss of Humira, because that was huge. They were covering it all the time, really beating up the stock for something that hadn't even happened yet. And overall, guys, the stock has just flown to the moon. My average cost originally was $88 a share, and I bought some more in like the 140, 150 range, I believe, just to get it. I wanted to get to 100 shares, but I didn't have the cash at the time. So I'm sitting on 100% return. The dividend has grown immensely. It was like $1.07 when I first bought it, so around $1, I think. Now it's like $1.47, I think, a share, something like that. I'm making almost $150 per quarter. So just really happy overall with the investment, and I plan on using that cash flow to buy more T. Rowe Price. So it's doing its job. By far, though, the best investment I've ever made. Then, of course, we got Visa at $286.50, one share. $286.51's our market value. Average cost is $268.29. 0.5% of the portfolio is in Visa. And guys, today we're up $7. Total, we're up $18 with a 7% return. I want Visa around that 270 mark, so I will happily wait. But this is going to be the second biggest overall position in the portfolio, right behind Apple. So overall, guys, this is going to be a huge position. I just have to be patient and wait for it. And it might not actually end up going that low, because Visa has an incredible business, a great balance sheet, really stellar margins and growth, and I use the company every day. So this is in the Coca-Cola vein for me. In the Apple vein, I love the company, and I want it to be a big position, and I think it'll be a huge needle mover eventually for the portfolio. And then, guys, we got T. Rowe Price at 103.69, 101 shares. I did buy, like I said, I bought a share of T. Rowe and a share of Realty Income today. $10,400 of market value. Average cost is right around $110 per share, so I cost down average a little bit there. 17% of the portfolio is in T. Rowe Price. Today, we're up $200. Total, we're down $600 with a 5.5% loss. Guys, I love T. Rowe Price. This is one of those set it and forget it companies. They're an investment company, so they technically are doing what I do, but they do it with mutual funds. So overall, the profitability of the company fluctuates based upon market sentiment and the overall economy, which I feel like I can really capitalize on. And I don't think the true value of T. Rowe Price is being reflected in their current stock price. So overall, guys, I love T. Rowe. It'll be one of the bigger positions. It's not going to be a Visa position. It's not going to be an Apple or a Coke for me, but it will probably stay a larger cash flow position within the portfolio. And so with that, guys, let's jump into the watch list. Starting off with Google, I've bought and sold Google a bit because I felt like it was a little bit overvalued. I just bought it, sold it again, which I was dumb. But I bought it at 167, sold it at 150, about 160, and it's at 150 right now. So Right now, it'd be a good buying opportunity for Google if I had the cash. This is going to be one of the top 5 positions in the portfolio as well. I just need to do a little bit more analysis on the company. The reason that I bought it and I sold it is simply because there's actually a lawsuit against Google right now, and I'm not sure how that's going to turn out. I'm not sure what they're going to break up out of Google. I did see that they were talking about taking the Pixel away. I've seen a couple of things about also about the fact that they're paying Apple and Samsung to make Google the default search engine, saying that that's all they're going to do is give them a slap on the wrist and make sure that Google is not the default browser on all Apple iPhones or Samsungs, which I think people would probably choose Google anyway over something like Bing or I don't even know. Like usually, I think it's just Bing and Apple. There are other search engines, but not ones that are as strong of a brand and moat as Google search. But overall, I'm just waiting to see what happens with the company and what exactly they plan on doing with the lawsuit against Google. Then we've got Berkshire. Guys, I talk about Berkshire every single video. I want the insurance float. And I also want See's Candy. Those are the 2 big things is I want Geico and I want See's. So, but they have BNSF. They've got so many different companies. They got Apple, Bank of America, Chevron, Occidental Petroleum. They own Visa, MasterCard, Amazon even. They own a lot of stock holdings as well. And guys, I want the best capital allocators in the world to allocate some of my cash. That's really what it's about. So this to me, as well as a set it and forget it, let the insurance do its work for you, reallocate that capital, and become a millionaire by Buffett and his lieutenants. That's it. And I know Buffett's old, but I do think that the culture of Berkshire is strong enough to withstand any crater. They have withstood so many different, economic issues, political issues, whatever, wars, economic downturns, just everything that you could possibly throw at a company, Berkshire has lasted through. They're very good at how much they keep on the sides to keep the company healthy. They've never jeopardized the company's health or its profitability. So I just think Berkshire is a tank that may not have great growth over the long term, but if they allocate capital effectively, it will have substantial growth still. So it all just depends on how they use that insurance float and reallocate their capital. But I want to own Berkshire. I do want it to be in the top 5 of the portfolio eventually. And then we've got Costco, guys. I want to buy this because I've shopped there. I love the experience. I do like their business model. I like that they pay their employees well. I like the positive sentiment that I've read online about the the customer experience, as well as Charlie Munger was such a big influence on me. I kind of want to buy a share to honor Charlie as well. So I'm not sure what price I want to buy it at because Costco's really expensive. The PE is sitting at 54. So it is a great quality business. It's got great growth. I understand the company, but I just want to wait a little bit because I want to allocate more capital to other things. But with that being said, guys, I just want to say thank you so much for watching. I know I took about a month off. I'm sorry. I'm going to try to do better about that. I'll have a video out tomorrow, and I'll do a video for the rest of the week. I want to get more uploads out there. So with that being said, guys, thank you so much for watching. Remember to hit the subscribe button on my channel, That Dividend Guy. And I'll see you guys tomorrow with another Robinhood portfolio update. Take care.